Well, good morning, and thank you for inviting me here to this summit. My name is Mike Helmar. I work for the University of Nevada at Reno. I deal with what is called the Food and Agricultural Policy Research Institute. It's kind of an umbrella of universities in this country. The main university in it is the University of Missouri. We work with folks from Texas Tech, from Texas A&M, whom you'll hear from today, from the University of Arkansas. And we do a collaborative look at agriculture several times a year, and then we use that to do scenarios off it of what happens if this occurs. Our main clients are the U.S. Senate and House Agricultural Committees, but we do work for a lot of other people. We do work for private sector. We do work for other public entities. We do work for some foreign interests as well. So with that brief background, oh, by the way, I wanted to say to the councilmen and councilwomen who were here that are providing us lunch, thank you very much. That will be the highlight of our day after you have to listen to me talk. So, and we do a 10-year projection. I'm going to present the first 5 years here. We do it for the U.S. and for the international sector, and I do the international crops part. But then each one of our institutions bring it down to our home states. We take a look at what this means for our home states, because that's really what's important to us as I sit in my office in Nevada, as opposed to talking to folks in Washington, D.C., is what impacts you folks. And so the things that we consider when we do the baseline are, first of all, global economics and population, tariffs and export taxes. Tariffs are a really big thing right now, particularly the ones with China. And they do impact Nevada, not as much as they impact agriculture in a lot of other states, because a lot of these tariffs are really geared towards some crops, but also to some livestock and dairy products. So we look at those. We look at area expansion and yield growth, and this is particularly on a global basis. That becomes very important because there's a lot of area out there that has just already been absorbed into producing crops, and in the current economic situation, there are very few countries that can expand area, with the exception of countries like Argentina and Brazil. Biofuels are becoming a bigger issue for us on a global economy, and those filter back into the domestic agriculture as well. How much grains and oilseeds are used to produce ethanol and biodiesel has begun to really make an impact in terms of our crop balances. And so those policies for biofuels are there. The shift in feedstocks used. As a matter of fact, one example here and we won't get into this very much, but for example, China has increased its ethanol requirements for use in that. And we looked at that initially and said, that's going to be a huge draw on corn. Well, apparently the Chinese are saying, yeah, it will be some, but they're using things like cassava and those sorts of crops that we don't grow in this country to produce ethanol. So they're going more to that. So that's a big issue. Then we look at livestock, poultry, and dairy demand growth around the world, as that pulls the demand for our crops, also pulls the demand for our production here in Nevada with our cow-calf industry and with our dairy industry. So what happens around the world becomes very, very important to us. So the highlights from the Nevada Ag Outlook, and we'll get into some pictures here pretty quickly, is that one of the things is that the global economy is maturing and it's growing at long-term potential. That means that bump up that we got coming out of the recession has kind of slowed down, and so those big increases that we saw in places around the world in terms of per capita consumption are kind of mellowing out a little bit. The dollar is no longer appreciating. That means it's no longer getting stronger against currencies of other countries. When that happens to the dollar, that is a disadvantage for American producers because it makes our goods more expensive in those countries. That has kind of ended or subdued for a while, and that means that the long-term purchasing power will increase for importers. That's a good thing, is that other countries that we export to, particularly developing countries and some emerging economies, as the dollar stabilizes, if it would fall, that would be better for us, but as the dollar stabilizes, we're no longer pushing that disadvantage farther. Oil prices reflect steady economic growth, and we'll talk about that. And you might say, is that really important for agriculture? Indeed it is, very important on several levels. We'll talk about that. Okay, we've had a period of generally low ag prices for major commodities, and we expect that to continue. Not at the levels they were just a couple of years ago, but at kind of modest price levels as we move forward. Nothing that is going to put your kid's college education and your retirement account in your banks. So that will be a bit of a challenge. And that period of generally low ag prices, the economic challenges are going to be really the greatest in this state, particularly for dairy and for the cattle industry. And that goes all the way down through the cow-calf industry of Nevada. But cost inflation, we look to see as being modest. Those costs are not going to go up very sharply like they did a few years ago. And more closer to the west and to Nevada, grazing allotments are an issue for the cow-calf industry. We're up against environmental issues that have taken some grazing land out of permitted area, but we also have some temporary reductions, and those are because of fires. Sometimes it's hard to get that land back into the system though after it's taken out. Okay, we're looking at improved water, and that'll support forage production. And one of the things that we're going to talk about is that the dairy expansion that we were hoping for in Nevada hasn't really occurred. We're falling short of the needs of the whole milk powder plant. And it may be difficult to get to where we want to be if we want to supply all those needs here in this state itself. A few years ago, we were pretty optimistic about it. Now, if we look at the economics, that's going to be a hard row to hoe, at least for several years. Okay, and this outlook, as we go ahead, assumes sufficient water and normal temperatures. We don't know when droughts and temperature things are going to happen. So let's start talking a little bit about the economic environment. I want to go through this relatively quickly because I really want to concentrate some on the dairy issues and some of the other livestock issues, which is why we're here. All right, this black line here, that's 2019, the year. And what this is real GDP growth, or about the economic situation around the world. The blue line, and I'm sorry, this is too close to the purple line, that's the world average. The red line are developed economies, US, Canada, Japan, Australia, New Zealand, the European Union, and those countries. The green line are the emerging economies, China, India, the former Soviet Union, and some other high-growing economies. And then the purple line are our developing economies, which generally have higher rates of growth, but in the last few years we've seen some issues with their growth rates. We've got some countries like, you've heard about Venezuela. Their economy is almost non-existent anymore. It's a lawless economy. Argentina, a very big economy in the developed region, and particularly in Latin America, has had some issues with debt, and they've pulled back on a lot of things. And then we have countries like Turkey, which is having issues, and in Iraq. Those are some of the larger developing countries around the world that are struggling with their economies. And we expect to see that's this year, and we expect to see that happen again the following year. These are countries that we generally look at as our opportunities for exports. Like, certainly we have our established markets, but we look at these countries as opportunities for growing exports, which is a big part of growing ag in the U.S. and in Nevada. So we have really kind of a ho-hum global outlook, and our expanding economies that we normally expect to expand, the developing economies, are a little challenge for the next year or so. Now we'll look at the exchange rate, which we talked about. And these are exchange rates, and these are by the same groups of countries. So we don't have specific countries here, although if you want them, I have them. The red is, the blue is again against the average of the world. You can see that we increased our exchange rates, that the dollar got much stronger compared to everybody around the world, and that is kind of slacking off this year and into next year, and it will stabilize. So we will no longer be losing those advantages in the rest of the world. And in fact, if we adjust for differentials in inflation rates between the U.S. and the rest of the world, we'll see like the developing country, rather the developed countries and the emerging economies will actually, on a purchasing power basis, will actually improve relative to the U.S. Not a lot, but some. So that will be an advantage. And the developing countries will actually flatten out and not lose anymore. So the exchange rate environment, which has been detrimental to U.S. trade of all kinds, including ag products, will improve. Okay, our interest rate hikes. Now this starts bringing it a little closer to home here, because you guys have to borrow. You have to borrow both in the short term and in the long term. In the long term borrowing, we'll talk about that here in a minute, but that going to have a real impact, and it has been having a real impact on our dairy industry. The blue line is the short term, represents short term interest rates, what you might borrow for your annual operating costs. Those have gone up, and here we are in 2000 and you know what? I made a mistake here. I did not move this bar out. That's 2018. Here's 2019. So you can see, and if you listen to the Fed talking, they say we're about done raising interest rates. There might be a couple of more, but we're probably done. But those annual borrowing costs have gotten higher. The long-term borrowing costs have also gotten higher. Now, if we look back here, they were lower, and they're going to continue up a little bit more, but not a whole lot more. But what this is when you go from here, when we started talking about dairy expansion, and the dairy expansion in Nevada was going to take some capital investment because we needed about an extra 16,000 cows from what we had back there in 2014 or so to supply the needs of the whole milk powder plant. Those capital investments that are needed if you bring in a new dairy farm, or you have to build more infrastructure on your existing farm, and you have to borrow the long-term cost for that, just became a little more difficult to get. Okay, and this is our oil price. And this is what has happened to our oil price. And here again, and I apologize, this line should be moved over one. I thought I had them all moved over, but apparently I missed a couple. So this is our estimates of our West Texas Intermediate crude price in 2019. Now the blue line is the actual nominal price, and the red line is adjusted for inflation relative to 2015. So you can see that we expect a relatively slow increase in petroleum prices. And having said that, today the oil price is actually about here. So we're a little below. But having said that, we're looking at relatively low increase in oil prices going forward. This is one of those things that I consider to be a major risk to the outlook. What this assumes is that all the reserves that are needed, all the developed oil fields are already there. So that we don't have to, if we want to increase the amount of available oil, it takes exploration and the amount of drilling that goes into it. And that generally takes, from people that I've talked to, takes about a $75 to $80 per barrel thing in inflation adjusted terms as we go out to induce that kind of exploration as we go forward. So I'm a little bit concerned with a global economy just humming along, that our oil prices are only going to do that. I suspect they will be higher in order to reduce the production. Having said that, there are a lot of reserves sitting out there right now. Okay, now we'll talk a little bit about costs. So we're looking at moderate cost increases ahead. So what does this chart really do for us? Well, the blue columns are the average over the last 10 years of cost of percent increase per year. So basically things were increasing at inflation or a little higher than the inflation rate as we move on out. The fuel are the ones we know what have happened to the very volatile fuel prices. And we actually have this year them dropping. I suspect if we were to come back and look at those numbers today, these were made off of numbers that were produced by IHS Markit, which is an economics consulting firm. If they were to do that today, I would suspect this red line would be flat or maybe up just a little bit for this year. And then the kind of whatever color that is, greenish or orangish or yellowish color, are over the next 10 years. So we expect to see oil prices will increase some, but nothing really increases too far beyond the rate of inflation. So your costs are going to increase kind of at the rate of inflation or maybe a little bit more. So given no economic shocks around the world, your cost of production should remain manageable. You should be able to get if you get inflation back on your products, you're going to meet your cost of production. The food spending. This reflects a mature expansion here, that our food expenditures per capita are going to about flatten out. So our domestic demand is not going to be the place where we pull increases from very much, particularly for things like meats and dairy products. A lot of it's going to be the international demand. Okay, now let's get to the crux of it. And I apologize, I understand that this is really a dairy-centric crowd. I'm starting off with the cow-calf stuff, but we'll get to the dairy things. So cattle producers are facing kind of a tough outlook as we move forward over the next few years. We've come off 2014 and 2015 were really our sweet spot for cattle prices. And by the way, Stacy, she may not be in here now. But when you talked about what was going on with showing the declines in those prices as you go forward, and you're comparing the ag census every 5 years, Tom was right. That's no guarantee that you're gonna hit the average or the highs or the lows. If you hit a bunch of low ones, it's gonna look terrible. Well, and that's kind of what happened when she looked at those things. But 2014 and 15 were our high spots. We move into 16 and 17 and 18, 19, 20. This is where we expect our cow-calf prices and prices throughout the cattle, the beef chain to drop, to bottom out in 2020. We're in an era of expanding herds across the country. We saw an expansion here in Nevada this year again. We're up to about 470,000 head in Nevada, which is up from about 435,000 head about 4 years ago. So we are expanding that cattle production in Nevada, just like they are everywhere else. But now as the prices drop, then there aren't going to be so many heifers being held every year. We're going to start dropping those cattle numbers, and we'll start to see the prices go up again as we move on to here. So here, basically, the red line is the U.S. feeder cattle price, and the green line is the Nevada feeder cattle price. And they pretty much move in concert over history. That's been the way they move. And here, it's not what I need to do. This line is a slaughter price, the U.S. slaughter price. It's an Omaha steer price. So as you can see that we're still pretty low. Now, if I were to show you the full 10 years as we move on out here, you would begin to see these prices move up as they will. But right now, we're pretty close to the bottom of the cattle cycle. And this is one of the reasons why that net farm income in Nevada is down so much, is because cow-calf industry, which is by far the largest agricultural sector in Nevada, is in dire straits right now. We're down in here. And so if you look at those numbers, those net farm income numbers, they look pretty bad this year, and they are. We are in a very cyclical state for agriculture, probably more so than most other states, just because of the nature of the cattle cycle. But one thing that our falling prices have done, even with a high dollar, has helped increase the U.S. exports of beef over the last few years. We can see that our imports have stabilized, but our exports have risen to the point now that the U.S. is now a net exporter of beef. And we'll look at where that beef is going here in a minute. If we move this down another few years, we're going to kind of flip-flop a little bit as the exchange rate moves, but we're going to be pretty close to self-sufficient in beef going out there. So here are our beef exports, and these are in terms of million pounds. This is 2018, the last year where data is available. So the green line, or the blue bar, is Japan, by far our largest beef market. And then Mexico behind it, as is their large too. What we can see, and then there's Canada, a lot of cross-border trade. South Korea, which is big. What you can see here is, if you look at South Korea here and Japan here, you can see that they dropped and then came back. This was the mad cow disease issue back in 2003 that started for a few years, and they shut off exports. Most of those exports have now been restored. There are some phytosanitary requirements in place now that all three countries seem to be happy with. So we're moving into those. And then there's the rest of the world, and that's everything else. The one thing that I want you to notice from here, and this next rest of the world is a whole bunch of other countries, and there's probably a few that are large, but what we don't see, who we don't see in this here is that we start talking about our tariffs again with China. You don't see China in this mix. So where there may be some tariff issues with beef going into China, it doesn't ding our industry as much as what happened here with mad cow disease back in 15 years ago. So China, we can weather the China tariffs, particularly if they end soon. Okay, so this is in terms of million pounds. Now, if we look at this here, though, we've had an increase despite a rising exchange rate. And if we look at this in terms of $1 million, we can see that the value of our exports is going up. That's because of our exchange rate, a combination. Our exchange rate is relatively high, but incomes around the world are high too, for the most part. So they're importing those things. And also some of the cuts of beef that we're exporting gets to be market specific. And some of the more valuable cuts of beef are going out of our ports. Okay, so now we're just going to take a look generally at basin and range cow-calf. And this is the whole basin. Yes, sir?
On a couple slides ago where you had the weight, the net import-export on the pounds, if you were to put the value on that, are the imports generally lower value versus the export higher value, or flip-flop, or is there a...
That's a good question. I would suspect that the value of the imports are probably higher because we don't import offal and things like that very much in this country. We import higher grade beef. I really don't know the answer to it, but I would suspect that. Okay, so where are we? Okay, so the blue line is the purchase feed cost for the cow-calf industry. The red line is the other feed cost, which in the basin and range, it's more than purchase feed because of grazing. Okay? And supplements and things of that nature. That's where most of our feed comes from. The green line are other economic costs out there, other inputs, veterinary, branding, you name it, your overhead. And then the black line is the gross value of production. That is, you take on, and this is on dollars per bred cow. This is the value of sales of cull cows, cull bulls, calves, steers, and all that. That's that value. So you can see that in this period, 2014 and 15, that in the basin and range, in Nevada as well, it was a very profitable year. It was very good. Now this is what has happened here. This is 2019, 18. Here's last year. Most of the profits have been wrung out of the cow-calf industry. And this year we expect to be about the same, maybe a little worse, and be underwater a little bit next year. Now we got to remember that this does not include long-term costs. It's only short-term operating costs. So this is one of the reasons why we have that big decrease in the net farm income that Tom showed you. And because of that, it doesn't matter what the prices do, but it matters more what the profits do, the net returns do. It's going to be hard to get in. What did I do? Where am I? Okay. It's going to be hard for us to get our dairy herd to increase higher. And here's our high point, what we expect in about 2019, at about 475,000 head in Nevada. We're never going to regain in this cycle where we were at 14, 15 years ago. It's going to be very, very difficult to do that. Also including the issues with the available grazing land sitting out there too, with land that has come out because of environmental factors, short-term losses and things of that nature. So the cow-calf industry over the next few years really is got to have tough guys in that, tough women, excuse me. You've got to be tough folks who've got to be in there because it's going to be a struggle. All right, now let's talk a little bit about dairy, which is why we're all here. How am I doing on time, Tom? Tom? Okay.
By the way, we got on film, you said I was right.
Well, I guess I'll have to stand by that then, won't I? Can we edit that out? Yeah, okay.
Posting it right now. You're great on time, Mike. You're fine.
Okay. So now as we take a look at what has come out of our factory system for on the dairy side, and we start looking at milk prices, well, you know, we all know what happened back here in 2015. Milk prices were good. The dairy industry was in pretty good straits, and milk prices just absolutely crashed. Well, we have a supply glut, the national supply glut. It's hard to get rid of those things, and we just can't get rid of all the milk unless the price is really low. Now I think Tom talked about the farm financial crisis back in the 1980s. Dairy was a big part of that thing. If you look at that in 1980s, and we have the same problem today. That was a glut of milk back then too, and it went to the point that in 1986, the federal government instituted a dairy herd buyout to reduce the number of dairy cows that were being milked then. And it worked for a couple of years. We saw some increase in prices, but milk yields increase, and they make each cow a little more profitable. And when there are good milk prices, dairymen have a tendency to increase their herd size. And so here we are today. We are here. We've got a lot of cows sitting out there. We're not reducing, and we don't have a dairy herd buyout on the horizon. The way to deal with this by the federal government has completely changed. It's no longer supply control, but it's going to be margin protection, and as it has been for the last 5 years with the last Farm Bill. What was the margin protection program, which is now the dairy margin. Anyway, I've got it on the next slide. But we're having a real hard time finding a situation where market prices for milk are going to show a substantial recovery. Certainly they're better than they were a few years ago here, but they're going to fall again and they'll come up. So that'll be a little bit of relief, but not a whole lot, because we still have some inflation in costs going on out there. So this is one of the reasons why dairy is where it's at today. It is really also, along with the cow-calf industry in this state, it is really pushing some economic headwinds on the producers. Oh, and by the way, the blue line is the all milk U.S. price. The red line is the Northern Nevada Class 1 price. The black line is the Northern Nevada Class 3A price, or what gets sold into the milk plant. So you're probably thinking, well, why don't I do this instead of this? Well, this is actually based on Northern California prices, and it's actually pretty close to the Northern California Class 1 price, where we ship stuff for bottling into California before we used it more in our dairy plant. So why don't we do that instead of this? Well, this Class 3A price gives us back to the dairy farmer about what that one did. The difference between these two is, if you sell it for that, you've also got a couple of bucks per hundredweight transportation cost you have to pay for. Now, we're no longer paying for that much transportation cost here in the state. So this Class 3A price is kind of the equivalent of that up there. So this is what a lot of the farmers that are selling into the Fallon plant are dealing with. And it's not a bad thing that you have that difference between those two. It's just a type of milk, and you save on transportation costs. The bad thing is just the level of milk prices, which our Fallon plant doesn't make the milk price, so we can't blame them, right, Al?
That's correct.
Yeah.
Thanks for pointing that out.
Yeah. Okay. So, in 1986, we had a dairy herd buyout program attempting to reduce the supplies. It was partially successful for a few years, and then the supplies came back. So what do we do today? Well, in the last Farm Bill, we had the margin protection program, which paid a fee if the milk margin over feed costs, and this was a predefined set of feed costs. It was corn, soybean meal, and alfalfa hay average prices that was set by the U.S. government. It didn't necessarily reflect local prices. And the milk price that was there was based in New England. So a lot of those things, well, yeah, you can kind of get to it in Nevada. It wasn't quite the same for Nevada as it is for other places. but you had to have a gap of at least $4 per hundredweight before you could collect anything. That is between your feed costs and your milk price, and then you could get that in there. And this gap did not include your other operating costs at all. It was only that feed price. So if you have other operating costs that were more for, you could be underwater on this thing and still not be able to collect anything if you consider the other prices. But as we look forward, we still see here, and here, I gotta stop doing that. I gotta stop doing that. If we look here, this level is that calculated feed cost. And it's $8 to $9 per hundredweight for that. And now we have milk prices up here, and this is a U.S. all milk price that it's calculated off of, $16, $17 per hundredweight. And it's hard to get a small enough margin to collect on the margin protection program. Now, you can get more than that $4, and now with the new farm bill that's been bumped to $5. You can get more than that if you pay a higher premium. That first $5 is free. It's $100 a year registration fee. And that's what everybody can get, but it's only on your first 5 million pounds of milk production. So if we think about what that is in terms of a Nevada dairy, that's literally just a squirt in the bucket. It's not very much. This dairy program was geared for northeastern and midwestern dairy farms. I don't know if any of you saw on the news the other night, it was on the national news on Channel 2. They did a segment on a Minnesota dairy farmer. I don't know if any of you saw that, but he was talking about his situation that just exactly mirrored what we've been talking about here. But they never brought in the policy and the margin protection policy. But market-wise, he wasn't able to make it. Now, he said that he had roughly 200 cows. And if you look at that, 200 cows times about the average milk yield for Minnesota, puts you at 4.5 or 5 million pounds of milk per year. So this program is geared towards that, what they refer to as the family farm. Not that any of our farms are not family farms, but they're not. The guy had, I think, less than 20 acres that he actually had, so he's buying all his feed. And then he was running his cows in there. So it's geared towards that size of farm. It's not made very well for a large dairy farm as we see in the West, particularly in Nevada. So it falls a little short. But you can buy up to now this time, instead of $8 as the top margin, you can buy up to $9.50 per hundredweight as a margin. And they've reduced the premiums a little bit. So it's a little better economically than it was before, but it doesn't cover most of what a Nevada dairy farmer is going to run into. So that becomes difficult for us. So here's one of the bright points in the dairy industry for the U.S. And these are like the beef charts that we looked at here a few minutes ago. Okay, so these are our dairy exports in thousands of tons. And that's fern tons. That's T-O-N-N-E-S, so it's metric tons. Okay, and I've broken it out instead of by country, but by product. So here's our biggest export is non-fat dry milk, and then there's whey and whey powder. And then we have cheese, and you can see that butter tried to come on a little while, but we don't sell much butter here, and then other dairy products. But we've seen an increase in the amount of dairy products that we've exported from the U.S. in the last few years. And hopefully that will continue. Now, our whole milk powder is actually, I appreciate your patience. The whole milk powder is actually in this other catch-all thing here. Whole milk powder is actually a relatively small product for export from the U.S. We export more non-fat dry milk than, or skim milk powder than we do the whole milk powder by far. And actually, in the whole milk powder, well, we'll get to that in a minute because I've got a chart to show you something about how we're doing in the whole milk powder exports. But just go here briefly. But we've seen how low the dairy price is, whereas we actually had still, you know, we had growing beef exports, and we had, even with low prices, we had higher values. Not so in dairy. We've had, our values have fallen since 2014. They're up a little bit in the last few years. So what's going on here? Well, where the U.S. can help form international prices in beef, as we're a big player in it, we produce a lot of it, not so much in a lot of the individual dairy products. And for example, our milk powder prices, you can see whole milk powder, I mean, rather dry, non-fat dry milk here, and cheese. We take a lot of other countries dictate those prices out there. And particularly the Oceania countries, in terms, and the EU as well, in terms of the milk powders, they're the big players in the world. Now we have a little more influence on whole milk powder prices than we do non-fat dry prices than we do whole milk powder prices, but not a lot. We're still taking some of those things. So our value of our exports, even though the export tonnage is increasing, are still kind of low as we're sitting out here. And if you take a look at the information that comes out of New Zealand, their ag department, and ABARES, the Agricultural Bureau of Ag and Resource Economics, and something else now, they put an S on the end of it, from Australia. Those are the guys that really have the milk powder prices dictated. They are showing prices that they've got plenty now. Now, once New Zealand got past its a supply issue a few years ago, and Australia's gotten past its drought issues, which could resurface any time because a lot of those are grazed cows. They've gotten, at least temporarily, past those things, and their prices are low. They've got plenty to share on the world market, and we kind of have to take that and deal with it. So, you saw the cow-calf chart for the profitability. Here's what it looks like for dairy. Whereas we don't suggest that on average, okay, that on average the Nevada dairy farmer is going to go into the red. Again, not with long-term costs, but just with operating costs, short-term costs. We don't have them increasing very much. You saw those milk prices that we had out there. They were pretty dismal. And we have just regular increases in costs as we go on out there. And that's going to keep that margin pretty low. And so it's going to be a tough outlook for Nevada dairy farmers. Again, once we get out past here, another 5 years, they're going to improve. But dairy is not going to look like this for several years. So dairy is going to be tough. Now, one of those things that I believe Tom said, that our dairy in Nevada, particularly northern Nevada, is now trying to be geared towards the whole milk powder plant. That indeed, if we have the markets for that, that is a boon for us here. Well, about 85% of what came out of that plant, and you correct me if I'm wrong, but that was at that time a few years ago was supposed to be destined for China. Yeah, we're still there.
Actually, a little higher.
A little higher now. Okay.
We've lost all the Chinese stuff.
Yeah. Okay. And so when China's importing, things are good. China doesn't always import. They are pretty volatile. Well, let's go by. Here's the one I really want to talk about. These are our whole milk exports from the U.S. to China. And as you can see, that when we opened the plant, we're doing pretty well, and then there's a lull, and then for a couple of years we did really well, up until last year, so the market, at the end of 2018, and the Q1 numbers, or first quarter numbers for 2019 aren't out yet, or at least I haven't seen them. China did what it did back here. It dropped out of the market. It dropped out of the world market. And that kind of backs stuff up. Now there are other alternatives for that plant as well to do some other things. But in terms of shipping into China, if China was to consistently do this, we can compete. But we're also running up against New Zealand. They're the big dog in the whole milk powder industry in the world. And their plant right now is humming right along. So we are really constrained at this point in time because of China. Hopefully China comes back in the market, and it does that every now and then. So that's going to be kind of a volatile opportunity for Nevada dairymen. I believe the opportunity is still there, but there are just going to be some periods where it dries up a bit. So that's not a real good thing for Nevada. Now, Now I just want to talk a little bit here. If we looked at those low prices and the low profits that we were projecting for the next 5 years, it's going to be really difficult to make the expansion that we need to fulfill the needs of the dairy plant here in Fallon, to do it all from northern Nevada milk. That's what we would really like to see, is local producers supply that plant. And it's been difficult. You know, at first when we started talking about this plant, I did some projections, and basically the projections is I just assumed that we were going to be able to meet those needs, that we were going to get the dairy expansion here, dairies were going to come in from California, other places that they were going to build. The economics looked pretty decent at the time, the borrowing costs were pretty decent, and so I just made an assumption that we're going to do it in a few years. Well, now as we've gone forward, and what we would need to do is get up to about 46 million head in the state of Nevada, which would be an increase of about, 46,000 head. Yes. If we had 46 million dairy cows in Nevada, we would be we would have cornered the U.S. market and more. 46,000 dairy cows to meet the needs of that plant, and we were implying that because of the economics with transportation, where the plant was located, that expansion would logically occur primarily in northern Nevada and in the areas Fallon and around there. Well, the economics didn't help hold that out. Plus, we had a drought in there that made feed production very, very difficult. So what has happened is, and here if we go to here, right there's our dairy cow numbers. In 2018, we went up from about 29,000, we did see an expansion, to an estimated about 33,000 cows. Nowhere near enough. And so I just kind of played around with this line and said, okay, we're not going to expand that rapidly over the next 5 years. We're still going to be about 8,000 cows short by the time we get out here. Now you can argue with those numbers out here because right now the economics don't bear it out, but who's going to invest and come into this state is a kind of a wild card right now. So, but even at this here, we're not meeting the needs of the dairy plant. So we're still going to be importing milk for that. And we did that. Where are we at, Tom?
You're fine.
What's that?
Oh, we're back. We're back. We're close to the right.
Okay. Well, I wanted to talk about sheep just a little bit. I know a lot of you may not be interested in sheep, but the reason what I've started looking at sheep is, well, first of all, we've got a possible university farm in Eureka, possibly coming in, a research farm for that. Plus, if you look at the sheep inventories, Nevada, the U.S., but particularly Nevada, that had declined since World War II. There were virtually no support industries other than a wool marketing loan, which has since been eliminated for sheep. Sheep inventories in this country just dropped dramatically. In the last 4 or 5 years, those numbers have leveled off, and particularly in Nevada. Now, there's a couple things that are driving that. One is we've seen a change in the ethnicity of this country. We do have more people coming in from places that eat mutton particularly, and some from lamb, Middle Eastern, and even some Latin American folks that come in that are more apt to eat that in their culture and their diets. So we do that, plus the wool. The wool in Nevada is a relatively fine micron wool, high quality. And because of that, it gets a premium. It gets a premium that it competes with Australian wool, very fine Australian wool. They set the world wool market prices. So what has happened here, Australian wool prices got very high. got very high in here. And that certainly helped our wool prices in the state of Nevada and helped increase the profitability of our sheep and wool industry. Now we have a drop here, and this isn't my projected drop, but this drop into 2019 and then coming back up is a projection from the Australian government that I defer to them because they really know what they're doing with sheep and wool, and they make the wool prices in the world, and they're saying that the prices are going to drop a little bit. They're still going to be very healthy, but they're going to drop a little bit in the last few years. And then our lamb prices are kind of linked to the wool prices a bit, so they're up there, and sheep prices generally kind of follow along. So the wool and the sheep and wool industry is one of the industries in Nevada that looks pretty decent in the next few years. And in fact, here's their the outlook for them. The blue bars are just operating costs. They haven't broken them out to feed and other things, but that's the operating costs. And here we are in 2019, and again, like our other livestock species, we see the operating costs are going to kind of move up with inflation as we move forward, unless something drastic happens. But with our gross returns that are still primarily from selling sheep and not wool. Wool is about 20% or so of the revenues in a sheep industry per year if we look at the typical budgets. But we see that we're going to maintain good profitability in that industry. So why are we able to maintain that profitability there besides wool prices aside? We do it in other places. Well, the projections are for the national flock is for something to kind of keep going on to reestablish itself a long-term decline in those numbers out there. And as we pull those numbers back, then we and with a little bit of growing demand, as we pull those numbers back, we're able to hold those prices that we see there in that particular industry. We're not subject to a whole bunch of variation. Not to mention that particularly in the cow-calf industry, we've got a longer cattle cycle. With the sheep industry, it's a much shorter cycle. So we look to see that the sheep and wool will be able to profitable for years. I think I'll leave it there. Needless to say, my next few things were just going to be that hay prices have come back a little bit, but nowhere near as high as they have been. We expect them to be kind of moderate over the next few years, and returns for hay producers will be okay. Questions?
When that you calculated the possible growth for dairy in this area, the consideration of having to have a commercial well for the dairy, the consideration of there were no very few modern dairies.
Yes.
The consideration of the cost and the already used up alfalfa that was here, there was a market here anyway. With all that being said, were all of the elements actually inclusive of the calculations considering the cost that the new dairy was going to take to build $1 million dollars worth of new dairy barns, because they're all old. I come from the dairy.
Yeah.
Shears Highway, 1950, 175 cows. We worked our butts off. We went broke every year. I was just a little kid playing with little plastic horses, sitting, watching the milk go through the pipeline. That's my question.
Okay.
How could it have happened, considering the cost to build new dairies and to even get the well, the commercial well, approved, and yet even find the water?
Okay. You're right. You're absolutely right, and I kind of hit on that a little bit when I started talking about the cost of production and that margin that was so small, and that was only above operating costs. That because of the higher interest rates and the fact that we were going to have to make some capital improvements, as you've outlined there, new barns, new wells, and things of that nature. We're going to have to make that to bring these expand dairy here in this area. That's one of the reasons why I said it makes it extremely difficult. Having said that, we've seen a little bit of an increase in the dairy cow numbers. And so I'm being overly optimistic here. My point is, though, is that we're not going to get to those dairy products. You're quite right that those...
I don't want to be right.
Well, but unfortunately,
I would rather
ma'am,
be wrong.
I would rather you be wrong. But you've hit it. Your experience tells you what's going on there, and that speaks to exactly what we're looking at. Now, my other comment to you, my first impression when you started talking, is that you're back in the 1950s. I couldn't think that you could have been on a dairy any earlier than like the middle 1980s. So you look much younger than that.
Good try.
Actually, we had one back there first, and I'll get to you, sir.
It's projected that the African continent is going to be the next place where there's a giant population boom. Have you looked at any trends moving toward Africa, exports, imports, what the market will look like for all of agricultural sectors?
Within our international models, we have several of the major African countries broken out for specific commodities. Now, having said that, let me back up a little bit. Your first statement is kind of correct about the boom in African population. It's correct because that's already happening. It's been a long-term thing. Now, if we get rid of all the wars and the refugee issues and things like that, then that population will grow even a little faster. But we're looking at the African continent as a whole growing 1.6, 1.8 to 2% per year in population, whereas the world total, including Africa, is less than 1% now. I think this year or next year it goes below 1% growth. So yes, that is a growth area, and that was one of the areas that we're hoping to see growth. However, when you start looking at economic growth, it's not only that, but the infrastructure and the geopolitical climate there, it makes it very difficult to distribute food in places where it's needed. Not to mention, as you look at the excuse me, the per capita income growth, it's no more for Africa. Even though it's high, total income growth is high, per capita is no more than the global average, which is below, or no more than the developed country average, which is below other developing countries and emerging economies. So that's going to be a very, very difficult thing. You have to take care of exchange rate issues. You have to take care of income issues. A lot of the folks in Africa are still at subsistence level, all right? You don't have the infrastructure to move food into a lot of those poorer places. And when you do, that stuff gets hijacked, gets stolen, and things of that nature. So Africa is an area that could potentially grow if things were more peaceful in that country, and they had the wherewithal to import, because they're not going to be able to produce that much of it themselves. Oh, if they improve seed, they will, but because of the population growth, it's hard for them to keep up with per capita consumption just on a subsistence basis. So does that kind of answer your question? Okay. Sir.
On that note, it's personal income growth that promotes a higher usage or higher demand for protein, and protein is what we make the money exporting, dairy and cattle and stuff like that. For that income rate, we're beans and rice and beans.
Yeah.
And, that's not where we make our money. But my question was on this slide, what do you see as the reason for the decline in alfalfa acres and hay acres in general? Is it population growth? Everybody's switching to hemp? What's going on?
There's a little bit of that going on, but primarily there's a drought here. That some of the perennial, of course it's a perennial, and some of those stands as they got mature weren't reestablished or were used for a few more years and have gone out. Now, we looked like we were going to try to come out of it for a couple of years. This green line here, this is from the potential plantings report that the USDA puts out the end of every March. This is Nevada total hay intention, and this is not planted. This is area harvested here because that's what they report. Is to be even lower. Now, having said that, I put this on here just for a comparison, but if I've made this chart every year, this line here looks nothing like when I put this line in the next year. It just doesn't look like that. But it says that at this point, the intentions were to harvest more hay. So that tells me that a lot of those those stands have not been yet reestablished. Now, this is also other hay in the eastern part of the state, particularly grass hay and stuff, is supposedly coming back some. But the other thing that I thought, we have water. We should be reestablishing some of that area, and apparently not. But I've seen a couple of things, and you talked about, you said another crop that you.
Yep.
Hemp, yeah. I don't know that hemp is taking over that yet, although it very well could as a higher value product. One thing that I've noticed is that, and you guys around here, maybe some of those that are doing this, but I'm just looking at the data. If you look at the corn silage data in Nevada, particularly over this period here, that silage has increased. Now, not a whole lot. I mean, we're talking about 15,000 acres. But if you take that 15,000 acres times 25 tons an acre, you offset more hay than that. And I've talked with some of our dairy nutrition guys, whom I will not point out sitting there in the back of the room. And other than, there's some differences in the nutritional value, but we can replace that. So if we get, let's say in Fallon, let's say if we can get 6 tons an acre, we've taken an acre and we've offset, every acre offsets about 4 tons of alfalfa. But that still is nowhere near enough to explain that big drop. The other thing that I kind of noticed that has kind of got me a little curious, and the issue is that in Nevada we don't have a lot of producers of a lot of commodities. So if we look at the data from USDA, it says we produce a commodity, but it doesn't tell me how much, because there'd be too few producers and it would give away some, personal financial stuff. Yeah, okay, this is my last thing, Tom. In 2017, for the first time, NASS and USDA reported corn for grain in Nevada. Now, it didn't tell me how much, and then in 2018 they didn't report that. So, but that tells me that if they reported it at all, somebody grew some corn for grain. And I don't know if that's going to be going on, if that has to do with improving the dairy rations in the state or not. But just something I'm wondering about. You may have an insight on that. Having said that, Tom's telling me I need to shut up.
No, you're good. I have one more question.
Yeah.
If you had time for one more. Do you go back to the dairy slides there, one of the last, basically showed that the
Which?
profit margin, see, there.
That one.
The profitability obviously was in 2014 there. I don't know if that's directly.
That was the sweet spot right there.
Yeah.
It was sweet for both that and CowCalf.
And we're back to what were the advantages there? Because now we're looking at a very slim profit margin, obviously.
Okay, now back then as we go there, we're going to have to start talking about the national dairy market. Okay. Yes, there are marketing orders, of which Nevada's not in one, but it gets pulled by the California prices, which is also in a state marketing order, not a federal one yet. But milk across the country, and particularly products that can be shipped. So it was pulled that. Dairy prices were high back there. I want to say the national average price was, well, there it is, right there. The national average, or the gross value of production there. The national average price was something over about 24 bucks a ton. You guys from A&M may remember that better than I do. But it was quite a bit higher, and it has dropped because of the supply glut that was sitting out there, plus some of the loss of some markets there for a while. So that was what we did there. That's one thing that dairy farmer in Minnesota that was on the news the other night, he said that his milk prices had dropped by about 1/3, and that's about right. So that'll do that. Okay?
Any other questions?
I have one.
Oh.
Do you think that the fear of getting into the dairy, a new market, a new dairyman, because of the historical problems from California with the radical preservationists, they like to call themselves environmentalists, but they're not. They're radical preservationists. They have sought to put so many of the dairies out of business, which they have in California. And that's why they left and went to Rome, Idaho, and that area. And the
Arizona, New Mexico, yeah.
Yes, and do you think that is actually deterring the idea of putting up with a very difficult type of living, being a dairyman, trying to grow a family as a dairyman? Do you think that has something to do with an individual's projection of sustainability.
Certainly, it does. I mean, when you go into something, you have to, look at, what are my options going forward this year? Having said that, we've seen some dairy move in from California because of what's going on in there. One of the big things in California was the manure treatment, manure handling. We don't have those regulations here. Are we going to get them? Well, I don't know. There's been some issues in some of the places in Nevada around mostly the manure smells, the odors that have caused some problems. Smith Valley was one of those a few years ago. But for the most part, well, and the thing about dairies have to be around waters. Towns develop around water, so there may be some of those issues as well. But we don't have those regulations yet. The thing to do is to keep making sure with the Dairy Farmers of America, use any lobbying thing that you have that can talk to politicians. You've got guys in the state that want to look out for dairy farmers. But anyway, so that's one point. Yes, but it's risky. If I looked at that and if I really believe that, I'm going to go do something else.
Can I interject?
Yes.
The Smith Valley dairy is absolutely the most beautiful dairy I've ever seen, and they were sued.
Yeah, and they put the kibosh on some expansion too.
And they did prevail. They won.
Okay.
They won that lawsuit.
Very good. That's good. But if we think that California, or at least the California psyche, is going to move over into Nevada, I'd be scared, particularly with that up.
All right, thank you, Mike.
Yeah, thank you.
Let's take a healthy 15-minute break here. I'll reconvene us a little after 10:15.